Hello, just when we thought we were done with geopolitical surprises, South Korea descends into chaos. The French government faces a confidence vote. All this as the world is still coming to terms with the new Trump government. And in Africa, South Africa's economy in the third quarter surprisingly contracts. It may not be an uneventful Christmas after all. You are welcome to another episode of Global Business Insights, where experienced analysts dive deeper into the headlines. But first, some of the data. After recovering slightly in October, the Eurozone Composite PMI output index slipped back into contraction territory at 48.3. Services PMI, that's for November, also fell from 51.6 in October to 49.5, also a 10-month low. Also in the UK, the S&P Global UK Services PMI Business Activity Index registered 50.8 in November, down from 52 in October, and also the lowest reading for 13 months. Worries about the impact of the autumn budget continue to hurt the broader economic outlook. Later today, the focus will be on the United States November ISM Services PMI data. We also get the US ADP, that's the private sector employment change data, and a speech from Fed Chair Jerome Powell, his last remarks before the December Fed meeting that comes up in a fortnight. The United States private sector is expected to see a job gain of 150,000 in November compared to 233,000 in October. That's the ADP private sector data we expect to get today. Traders still see about 73% chance of a 25 basis points reduction by the Fed this month, with 80 basis points of cuts expected by the end of 2025. Earlier in China, services PMI declined to 51.5 in November from 52 in October, also less than expectations of 52.5. Indeed, we see Asia risk off as geopolitics dominates global markets. The Dow Jones eased down around 200 points yesterday, despite an upbeat U.S. job openings report. In the U.S., job openings rose and more workers quit in October, both being signs of possibly a healthy job market. The number of postings for new jobs rose to 7.7 million for October versus 7.4 million in September. The categories increasing the most include professional and business services, which saw 209,000 job openings. Markets were caught off guard when in South Africa the gross domestic product contracted by 0.3% compared with revised growth of 0.3% in the prior period. The main story shaking up markets, although South Korea's President Yoon Suk Yeol lifted his order to put the country under martial law as thousands of protesters took to the streets and Parliament voted unanimously to end it. That was yesterday. The move has plunged the country into political turmoil and spooked investors in South Korean equities, with the opposition calling for impeachment of the president. Nigeria's Eurobond achieved a milestone on Monday, raising $2.2 billion after the country returned to the international market, also recording peak orders in excess of $9 billion. The 6.5-year bond maturing 2031 and 10-year notes maturing 2034 were priced at 9.625% and 10.375% respectively. This was just before the Economist Intelligence Unit, in its latest global commentary released yesterday, said the Nigeria's business environment will remain among the most challenging in the world over the next 5 years. Given high non-OPEC supply and demand concerns, OPEC Plus members are expected to roll over targets as Saudi Arabia's Crown Prince Mohammed bin Salman visits the UAE for the first time in 3 years. OPEC Plus, when they meet on Thursday, 5th December, that's tomorrow, via video conference, they are expected to be aligned on the extension of output cuts until the end of Q1 2025. China has banned U.S. shipments of several dual-use minerals and metals used in semiconductor manufacturing and military applications in a rapid retaliation by Beijing against export curbs from Washington. Washington had recently imposed a range of new sanctions designed to slow the development of China's semiconductor industry, also adding 136 Chinese companies to a U.S. trade blacklist, including major Apple and Samsung supplier Wing Tech. After what looked like stabilizing economic activity in October, the euro area economy fell back into contraction in November. It is looking like stagflation for Europe. Weak demand conditions and shrinking new private sector orders for 6 months in a row were mainly responsible. According to data collected from November 12th to the 26th, activity levels in the service sector saw its first decline in output since the beginning of the year. Factory production volumes also fell for a 20th successive month, the longest sequence of contraction in the survey history. The survey said 3 major Eurozone economies of Germany, France, and Italy all registered contractions in business activity in November, while other Euro area nations like Ireland and Spain posted expansions. Also, for a 6th month running, intakes of new work shrank across the Eurozone in November, and additionally, the pace of decline was the steepest in the year to date. Indeed, both manufacturers and service providers reported lower volumes of new business, although factory sales fell by a considerably stronger margin. Export performance was also a heavy drag on the euro area economy, with new orders from non-domestic customers down at a faster pace than that of total sales. In his comments, the chief economist for Hamburg Commercial Bank, Dr. Cyrus de la Rubia, says an early recovery in the services sector does not seem likely, as new business has dropped for the 3rd consecutive month, adding that most other indicators also suggest more challenging times ahead. In the recent past, discussions on issues hindering South African economy were more on power outages as Eskom went from crisis to crisis. Now analysts are caught off guard with recent reports that South Africa in the 3rd quarter sank into contraction as drought and extreme weather conditions plagued agricultural harvests. GDP, that's gross domestic product, contracted by 0.3% as the agriculture sector saw a 2nd consecutive decline, down by 28.8% in the 3rd quarter. Already, the Department of Agriculture agreed to issue import permits for genetically engineered white and yellow corn from the US after the drought caused a 23% drop in domestic production. Also, Ramaphosa has made it clear that BRICS countries are not discussing promotion of a new currency for trade as was speculated. President Tinubu is in South Africa to discuss cooperation and synergies between the two leading economies in the continent. Most analysts see more opportunities in intra-African cooperation than from elsewhere. Last month, the Finance Minister Enoch Godongwana cut the growth target for this year to 1.1% from the 1.3% target set by the previous government in February. Over the next 3 years, he said he expected GDP growth to average 1.8%. He also said debt has risen too fast and is too high. Foreign investors are still uncertain about the government's ability to translate positive sentiment into a real uplift in GDP growth. It's all about sustainability in an environment that has seen more inconsistencies in pro-growth reforms in the last decade. South Africa is uniquely positioned with many positive factors, including macroeconomic stability, to position as a hub to produce for the continent's growing consumption and for export as it works hard to debottleneck hindrances like in the power supply by installation of more than 6 gigawatts of private solar energy in the country and a 36% reduction in waiting times for vessels to dock at ports. Analysts say a consistent push at pro-growth reform can push GDP growth to over 3% as investments are attracted, but this is not expected to happen in the near term. I recall at the first Trump outing, I had the opportunity to be at the World Economic Forum in Davos when the then US President Trump attended the meeting. The mood was that of arrival of a dragon in need of a prince to rescue the kingdom. This time realities have changed a bit. Both France and Germany are seeing almost imminent geopolitical shifts and weakened economics, and the attitude to Trump 2.0 is more pragmatic and respectful of American voters. Europe, you could say, has a lot on its plate and will be thankfully relieved if anything can make the Ukraine-Russia crisis go away. The prospect of bankrolling the war as US tightens its wallets is not appealing, to put matters mildly. Weak PMIs in Europe and a stuttering post-COVID recovery is also complicating matters as Europeans call for more attention to domestic issues. EU technocrats like Draghi and Lagarde say Europe has declined on many fronts. There is a sense of too many stifling rules that may be snuffing out growth, and the result, of course, is Europe lagging behind others. Biden injected billions of fiscal ballast into the US economy post-COVID, and if you add more largesse in the CHIPS Act plus huge defense spend for Ukraine, it was no surprise inflation was sticky, but this must have also reflected the economy and equity prices. Most major US stock indexes are at record highs, and a Trump government is promising to be even more business-friendly, especially to the new technology AI-driven revolutionaries. Europe, in the words of Lagarde, is looking more like a museum unless it takes bolder reform steps. But latest PMIs show that US factory activity continues to contract, albeit at a softer pace in November, rising to 48.4 from 46.5 in October. Also better than market expectations of 47.5. The difference is that a very US-centric Trump is promising to deliver policy reform to boost its real sector. Europe is offering little, and citizens are noticing. Trump, who dislikes multilateral experiments and broad-brush trade pacts, hopes to succeed with dramatic cuts to governance costs via his Department of Government Efficiency, DOGE, and to achieve gains in productivity by unleashing AI-driven technology change. Lower US taxes will throw spanners into global tax pacts seeking to make the rich pay more taxes. More US deregulation plus less fiscal incentives for cleaner energy will all be problematic for Europe. There is no doubt that Trump is overpromising and most likely will underdeliver. Europe, however, needs almost desperately for Trump to fail, or it will be forced into many changes. As a headline in the business media recently puts it, Europe will have to fight back vigorously with innovation and much higher productivity. Asia-Pacific stocks are lower after South Korea's political turmoil triggered by a brief imposition of martial law and calls for impeachment of the president. Investors are understandably on edge as the situation further develops. Well, that's all we have on this episode of Global Business Insights. This is Bode Oshosami. Thanks for sharing, and thank you so very much for watching.